All right, so for everybody in the recording, this is going to be part two of the lower time frame entry scalping with a higher time frame bias mini series. And today we're going to talk about real life examples that you guys could have caught. So the first thing that I want to make very blatantly obvious is the fact that you should have a higher time frame bias, first of all, right? But what do you do when a pair is ranging? So first of all, we should think about it this way: what pair or what index controls USD pairs? It's right in front of you guys, right? It's the dollar index, right? So the dollar index, if we see the past week, it hasn't broken out of a range, meaning it's a ranging market. We see from here and here, it's simply a ranging market. Nothing's going on, right? There's no explosive movements. It's consolidating. What can it be consolidating for? Well, truly, it could be consolidating for a lot of things. It could probably be consolidating for maybe some pairs, maybe next week, there's going to be a lot of a volatility injection into the dollar, or maybe the week after there's going to be something else going on, right? Stuff like that. Right now, we're consolidating. And what do you do when you're consolidating? What happens when you're consolidating in a market? What are you supposed to do? Are you supposed to look for really, are you supposed to look for very, very heavy moves? Are you supposed to look for swing moves? Or what are you supposed to look for? You're supposed to look for short-term moves, right? You're supposed to look for scalping moves. So if you're looking for short-term moves, that means that you're probably going to not analyze the pair, off of the 4-hour, because there's nothing going on in the 4-hour. What are you going to be doing? Well, very simply, you're going to be looking for trades that are a little bit more short-term. So if we look at that, let's say like the 15-minute or something like that, you'd end up realizing, firstly, that there's too much movement in Asia range for today to be a very, very solid day, right? But there's still possibilities of price moving in different directions. So if we take a look at this and we kind of see this objectively, we end up seeing that there's a lot of movement in different places, but there's not much structure, right? There was a lot of liquidity being left behind here. So obviously a move to take out that liquidity was kind of expected. But let's say we were trading from the beginning of, so like the middle of London into the end of London close through New York. Let's say we were doing that. And let's say we were going down to the 1 minute. Well, if we were doing that, you'd see that there's a lot of entries and there's a lot of microstructure here, right? There's a lot of microstructure. So let's kind of assume that your 15-minute time frame is, or even, your 5-minute time frame is your daily chart. Let's assume this is your daily chart, right? Or let's assume this is a higher time frame chart. Let's look at the 5 also, If we look at it this way, it kind of becomes a little bit more obvious, right? If you want to use lower time frames as an entry point and there's a ranging market, one of the wisest things to do is to zoom out a little bit and try to make use of the range. But what you want to do is you kind of want to play the microstructure, meaning you don't want to go for long-term targets. You essentially are scalping because the market demands you to do so, right? So if we're looking at this objectively, let's say we're looking around like, let's say this area, right? Middle of London. We see that we've just taken out a point of liquidity. So if we've just dipped into liquidity, perfectly fine, right? We've gone below it. So now we can even go into lower time frame structure and look at what's going on. you see that there's a lot of buy side liquidity that was left here, so that may be a point of interest. Now, if you've already taken liquidity, that means that it's valid for a reversal, right? That does not mean that it is a reversal, that it will be a reversal. That simply means that you have a little bit more confidence for a reversal. So if we're on the 1 minute now and we kind of wait for price to do its thing, maybe there's an entry that we could possibly take. Now, if we kind of look at how price is reacting here, is there an entry that you could have taken here?
Yes, sir. Yes, sir.
So we're looking at where price is right now. Where's an entry that you could have taken or that you think about taking?
1.31715 the breakup structure. Yes.
All right. Can you repeat those numbers?
1.31775 or something like this.
Okay, you lost me on the numbers, but essentially the one that I'm kind of looking for is you have a point of interest here, you have a point of interest here, but there was a break of structure above, which is something that we would like to see. So theoretically, this is something that you could have that you could have taken advantage of if price comes back to it. Now, unfortunately, price never came back to this fair value gap. So to me, this would have been a possible entry. This fair value gap right here, price would have come back, nicked the fair value gap and gone higher. Another thing that some people may have said is, well, this may be a mitigation block, right? That price comes in and takes a mitigation block. That would be theoretically correct, but I feel like that's very much hindsight, because I would be scared of these equal lows if I was taking this in real time. That's exactly what we're making use of the replay function, not to give us the benefit of hindsight, but rather to give us the benefit of kind of analyzing it and kind of simulated real time, right? So now we're seeing how price is reacting, and we have to match our 5-minute structure to what we're seeing on the 1 minute, right? There could have been some entries that you could have taken between, right, on the 5 minute, maybe if you were paying attention. But to me, what the highest target is probably going to be around here. And the reason for that is because that's the point where the highest point of liquidity is. You could have also said here, though that's a little bit more high resistance. Either or, these two are my targets, right? So this one's going to be my first target. So now we keep that in mind and we continue. Is there entries that you guys could have taken on these positions? Is there an entry that you guys see here? Is there an entry that you guys could have that you guys see that you guys could have taken here?
Maybe at the 1.31819 area.
Yeah, so around this area, right? There's something of a chain of blocks here. Now, again, like I said yesterday in class, don't confuse an order block and don't say everything's an order block, right? However, in this case, this area is saturated with previous structure as well, because if we look behind, this was a major level, at least on the 1 minute, right? That was that a lot of price passed through. So in my opinion, this would have been fine, though I think in real time I wouldn't have taken this, simply because of the fact that there is a fair value gap beneath it. So my kind of discipline would have said, no, don't take it. It might wick the fair value gap beneath. Though you could have even done something like this and taken something like that, and then just drop this all the way to your target, right? That is something that you could have done to kind of, and again, that's what I'm saying is abuse the small stop loss so you can have multiple points of structure in your trades. Now, remember, you don't always want to have like a 1 pip stop where you're like, oh, I'm so good. No, be realistic with your stop loss, right? Abuse the fact that it's a small amount of pip count here. If this was a larger time frame, I wouldn't do that, right? I'd risk 1% here, and then I'd risk 1% here if it came down here, right? I wouldn't do both in one trade. So that's something just to think about, right? Obviously, that's a little bit more in hindsight, but that's something to think about. Now, there was a point here, specifically right here. What is something that could have kind of pushed you? And actually, let me kind of let me see something right here. So when it comes to this part of structure, what do you guys think could have happened at this point? What would you guys have thought at this point in structure? So specifically at, I missed the replay button. Specifically at this point. Would this have been valid to you guys? If you guys were looking at this, would this have been valid to you? Why or why not? Both answers are correct. Obviously, in hindsight, we see that it is correct. When I was first seeing this morning, I thought, I suspected that this would be a block that holds, but I wanted to bring it up as an example in class. So I want you guys to kind of tell me honestly, if you guys were to see a chart like this, exactly like this, what would you guys think?
So I must take the trade for a sell due to the breaker block.
Okay, so you would have taken it sort of like a breaker block, okay? Except there's no breaker here. Though I do see what you mean. So you'd come back to this point.
Yes, sir.
Okay. So, you know, a lot of you guys know that I'm a big fan of breaker blocks, and simply that's because breaker blocks have the higher probability rate. So if you can ever see a breaker block, take a breaker block, right? That's something that I like to say. Instead of an order block, take a breaker block, okay? Now, does anybody else want to share? It's okay if you're wrong. It's okay if you would have said no. It's okay if you would have said yes. I just want to know what your thought process is right now.
Sir, can you repeat the question again?
So my question was, so if you were to look at this chart right now, right here, what would you think? Would you think you would want to sell? So let me actually rewind it a little bit more. Right here, would you want to sell, or would you skip that sell into a buy, or would you skip that sell completely? Why or why not?
Sir, I will go to check liquidity on 15-minute chart. If there is a liquidity above, then I
Okay.
will buy, because
Okay.
it will these candles are targeting for the liquidity that is situated higher or above.
Right. So these candles are kind of going more towards a higher time frame structure, right? Towards high structure. The only reason why on lower time frames a lot of people would have said this is a successful sell is simply because you have these equal lows, right? You have these lows here that you can work with, and you can even put them as targets. And a lot of people would have been drawn to those sells and said, okay, well, I'll risk a sell here because, you know, this is essentially another pattern that you see a lot within trading, is also you see a consolidation, right? You have a point where price takes liquidity or stop hunts, right? This is your stop hunt. And then from there it drops, it breaks minor structure, meaning it breaks this low, right? And then after that, it retraces back to the origin, which sometimes is an order block. So for a lot of people that have seen this pattern before, they might even say, hey, I really like this pattern. I'm going to take it, right? I'm going to use it. And those people would have been correct, right? That is eventually paid off. Though, let's think a little bit about what DK said earlier. Would it have worked as a breaker block? And we can see it working right now. Would it have worked as a breaker block? Well, that's something that, unfortunately, it tapped it, right? So what he would have wanted to do is he would have wanted to do something like this, to take that lower. But we have to remember, this is a very good example of the definition of a scalp, plus not ignoring your higher time frame target. So a lot of people would have gone into sells here, but they're short term. And what I mean by short term is literally you get in, you get out. It's less than 25 pips, right? Why would we consider sells short term material? Why are short term? Why are sells short term and buys a little bit longer term? Longer term in terms of the 1 minute, right? Why do you guys think the sells are short term?
Because sir, it is creating more liquidity in
Okay, think about the higher time frames. What's going on in the higher time frames? What was our target? Our target was all the way up here, right? Wasn't this our target? So if our target is higher on higher time frames, we kind of want to follow our bias. If we see that price is looking up here and you're saying, okay, well, I want to take short-term sells, my suggestion to you is go for it, but remember that you have a higher time frame target. So let's say you would have gone for this, right? Oh, this is a long position. Whoops. Let's say you would have gone for this. You have your stop loss, right? For me, your take profit would have been below here. Can anybody tell me why? Why would that have been my take profit if I would have taken that sell? Well, of course, with hindsight, we can say, oh, I would have got it right to the pip, but that's not the point. The point is being realistic. Why is this my take profit? Can anybody tell me?
Is it because of the previous low?
Right, exactly. So not exactly the previous low, but rather the previous high, right? So you have this point here. You have the liquidity right there, right? The pool of liquidity that you were looking for in the first place, right? And then from there, it returns to structure. So not exactly your previous low, but essentially you have a previous structure behind it. So you see this, that's exactly, and remember that I said that price had wanted to come back to that area beforehand, and it did again. Does that make sense?
Yeah.
So you see how this pool of liquidity, these equal lows right here, 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 and here, right? Well, of course, these are new, right? But you have this area where there's a lot of lows. And when you look at that, that's something that tells you, okay, there's liquidity here. So to me, it would have just been the end of the pattern right here, just 10 pips, 4%, you're done, right? And the reason why I wouldn't have held it all the way down here is because you have a higher time frame target. If you guys remember the 5 minute, we have a higher time frame target, which is all the way up here. This is take profit 1, this is take profit 2, right? So if we look at that, what ends up happening? Well, right here, we're given a very good entry. We're doing a very, very good entry right here. Okay. Can anybody tell me what entry we're given within this consolidation? Can anybody find it?
So bought from the equilibrium and Wyckoff, it is a kind of Wyckoff around that region.
So I don't trade Wyckoff, so I'm not thinking about it in terms of Wyckoff.
It's a Wyckoff interest. I found it.
Does anybody see the pattern that we could have taken for entry?
It looks like mitigation block. Price has given a failure swing.
Right. Actually, you're correct. So in my head, I kind of think about a mitigation block and a breaker block as the same thing. So I was about to say a breaker block because they're super similar. But essentially, we're looking at this area. And the reason why we're looking at this area is because this is the origin of the move that broke structure. So we're looking essentially at this point specifically, right? And if we actually move it all the way back, show you exactly where, right here. That is the point of origin that we're looking for. And we do it this way. Like that, okay? And now our target, once more, is up here. Okay, now you see that there's a little bit more of a, what's it called? You see that there's a little bit more, a little bit bigger of a stop loss. Remember that the stop loss is up to you, but the stop loss can also be put into different places. What other places could this have been put at? Well, this could have been put at right at the bottom of structure of the point that broke, or that broke structure, which is, you know, right here. You could have put it here as well, but you don't want to be greedy. If you made 1%, you know, a day for a month, you'd make around, how much is that? 20% a month, right? 1% a day is
20%.
however much a month, right? So if you're already making, like, let's say right here, you're making 3%. Let's say you aim for the wicks, right? And you have 3.5%. Okay. So if you have that 3.5% and you know, your take profit ends up hitting, like, you know, it ends up hitting here, then that's a very that's a very good position, right? This is a very good position. You've secured 3.5%, which ends up, you know, going into your account. You make 3.5%, and let's say you would have caught the sell 4.5%. You already made quite a bit today, and that's on one pair during a ranging market. So one of the most difficult things that I've come across in my trading career has been coming across ranging markets and not knowing what to do. Because for a long time I was a diehard swing trader, right? I would not like to take anything below, you know, like the 4 hour, because I didn't want to be stuck in you know, at my desk all the time. But if you kind of treat this like a job and you're sitting at your computer and you're trading from, let's say, New York kill zone, which starts at 7, and you end at like 10 or 11, right, which is the end of London kill zone, or of London close kill zone, you end up catching a lot of moves. And you know, you start kind of realizing that it's not as hard as people make it out to be. So when you start kind of looking at lower time frames, especially on a ranging market, you make a lot of money while everybody's kind of sitting on their hands or sitting back. And that's something that will benefit you as a trader, and it'll benefit you when you try to pass your prop firms, when you try to pass your, you know, different challenges, right? It's something that will help you. So in my personal opinion, I think this was a class that showed, you know, that these entry points are very, very strong. And if you have a higher time frame target, then that's something that you can very well, you know, put into play. So that's something that I'm kind of proud to show you guys. And also, that's only on GBP USD. There's something to be said about EU as well, because EU was very clean today. Now, if we looked at EU objectively, right, and we looked at it from, like, let's say, and this isn't on replay, right? No, okay. So if we looked at this today and we kind of saw exactly what was going on, a lot of people's first thoughts would have been, okay, well, we're ranging again. Obviously, we're ranging today. The dollar's still ranging. Of course, the dollar went higher, so EU went lower, right? Like that. But is there a way that we could have that we could have taken these trades from a perspective that we're, you know, kind of taking it on the lower time frames, making the most out of the range? Because you kind of want to squeeze the most out of the range. So if you're squeezing the most out of the range, let's see what you could have taken. All right. So right here, you see kind of a larger swing move. That's not something that I would have been interested in. Some people may have been interested in this swing high. That's perfectly fine if they want to. my eyes would have been more drawn towards this. So you see this this fair value gap here, like that, right? And you see that it's a movement downward. It breaks structure, it comes down. So this is something that I would have liked to see. However, even before this, I was looking at this, right? This is something that I saw. I would have actually been kind of tempted to go into this, right? If price would have went lower. Now, obviously, this is a mitigation block also. So this is something that you could have taken, right? You could have targeted the mitigation block. This is a trade that I was going to send out earlier this morning, but I ended up not sending it because it missed my alert. So since it missed my alert, I didn't send it. But that's something to kind of think about. That's something that, of course, I didn't have a very set target for it. But originally what I was thinking is I was thinking either here or inside the fair value gap right here, right? Well, not fair value gap, but rather buy side liquidity, right? So I would have liked to take my target up until this point, which that's where price went ultimately. And that's where I, on my own personal account, I didn't send this out because this, scalping is kind of hard to send out as a signal. That's where I took this, right? So in this position, what I would have liked to do is I would have liked to take a buy from this point, right? Obviously, right at the wick is something that you want to do. And then my stop loss would have been quite simple. My stop loss was probably going to be within this point, within this area, realistically, probably right here at the bottom of the wick. And then, your take profit would have been here, or let's say I wanted to net 3%, that would have been 3%, right? And that's something that you could have taken. Obviously, I didn't take it. The one that I took was here, which we'll focus on here. But I did have this marked up, as you guys saw. I did have this line before you guys even, got on the call. So that's something that that I was looking at, but I ended up not taking it because I wasn't looking at it, missed my alert. So this one here, though, you do have your fair value gap, right? And as I've said before, fair value gaps are not entries, but they are price magnets. So if they're price magnets, they are going to be something that leads into something else, to put it, simply. So in that case, what do we see up here? And let me make it a little bit easier for you. What do we see right here?
Stop run.
A stop run.
Order blocks.
Right, exactly. This is an order block, right? This is at least the structure of an order block, right? Because you did take your stop run, and you did run stops. You did run liquidity down here. So now what are you doing? Essentially, you go higher, right? You tap into this fair value gap, and you could have easily taken it from the 50%, which is something that I've been trying out for lower time frames. And 50% on a fair value gap actually works a lot better on lower time frames. But let's assume that we take it from the order block. And now some people are saying, well, why are you taking it from the wick? Well, the reason is, as I said yesterday in class, I do not want to discriminate against wicks on lower time frames, because the difference between a wick and a candle is very minimal on lower time frames. So that's something that I would have kind of, had in the back of my mind. Now, what is my target? Can anybody tell me what my target is? See the 5 minute. Well, my target seems to be here. Anything else is whatever, right? We want to base our targets off structure. That's down here. And let's say you close it afterward and you leave a runner, though I don't like leaving runners because that's just like, I'm wasting percentages, right? So I just kind of, I would have closed out right here. That's an easy 6%. You're done for the day. You don't need anything else, right? 3%, you're done for the day. 5%, you're done for the day. 6%, you're very done for the day, right? That's something that you kind of want to integrate into yourself. Now, does everybody see why I took this trade on my personal account? Does everybody see that?
Yes, sir.
Sir, I took this type of trade most often.
Yeah, so it's a very simple trade, right? It's a very simple trade to take, right? It's not something that ends up being very difficult. It's something that is quite easy to take, right? And at the end of the day, it kind of it you become very comfortable with it, in my opinion. So I think, you know, when it comes down to this, I truly prefer taking these kinds of trades over, you know, anything else. I really prefer taking these kinds of trade over anything else because they're just so much more comfortable, in my opinion. If that makes sense to you guys. Okay. So what other trades could we have taken? Well, do we see anything within here? Not really, right? There's nothing there. Do we see anything within here? Very, you know, not very good. What about lower? Well, there is this, right? That you could have deducted this as a failure swing, right? And then from here you had a mitigation block. Now this is a lot more of a theoretical position, obviously because we have the benefit of hindsight. And also because I wouldn't have known where the heck to put my stop loss. And also you have a lot of liquidity back here, in these candles at least. So this is a very, you know, if position, right? It's not something that I would have liked to take personally. But that is a type of structure that you could have seen, right? What else? Does anybody see anything? This is actually a very good point right here. So you have a fair value gap within this area. You take it from the 50% of the fair value gap, and you get a nice entry. Again, you kind of already passed your target at this point, so your new target is back here. And that's something that you might have looked for. For me, I would have taken it at the open. So, you know, kind of cutting your risk reward in half. But I don't care about high risk reward. What I care about is getting in the trade, getting my 3, 4, 5%, and you're out. Now, of course, this is only if and only if you didn't catch this. And do you guys kind of see a pattern here? How these fair value gaps get played into when they're continuation? So this is a continuation of a downward movement. Price retraces, wicks into the fair value gap, and goes lower. Do you guys see that? How price also does the same here. It's a continuation of a downward move, consolidates, wicks the fair value gap, goes lower. Do you guys see that pattern?
Yes, sir.
I hope you guys see that pattern because that's a very, very important pattern for you guys to see. All
In
right.
current market also there are fair value gap is there. Barrier cursor, yeah, down.
Right, exactly. So this is kind of a concept that you can take to higher time frames as well. A very important concept that you can take is very simply, you have a point right here, right? You have a fair value gap above, price wicks in or fills your fair value gap and then goes the opposite way. That's definitely something that happens on higher time frame markets as well. All right. Does anybody have any questions?
So what happens to that imbalance which is below failure swing?
Which imbalance?
Just below your failure swing?
This one?
Above it?
This?
Yes, sir.
So that's not
What happens to that?
that's not an imbalance. Remember that so do you mean imbalance like in the way that Zay defines an imbalance?
Yes, sir, probably we can consider it as an void.
Right. So to me, I don't consider it a imbalance. I don't even use the word imbalance. I use a fair value gap. Because it has structure behind it, I don't particularly like this candle as a fair value gap. And also because it's a move that broke structure and price retraced back into it into previous structure. So if it's like if there is any points behind a kind of point of entry. So for example, in this case, we have what's it called? We have a mitigation block right here. So if there's anything above that mitigation block, we can go for it. But remember that price is lazy. So price is going to go for the path of least resistance, which in this case, it's going to put as little effort as it possibly can. And in this case, the point that is least effort is right here, right, for the mitigation block. So if price has already triggered a certain block and price has already moved away from it, don't worry about anything that you could consider an imbalance. It's not going to get tapped right now. Now, something that it does become is if it starts reversing, this becomes buy side liquidity. Does that make sense?
Yes, sir.
So it doesn't matter right now, but if price starts reversing, then it becomes buy side liquidity. Okay, does that make sense? I hope it does for everybody, not just for him.
And so it is also maintaining efficient price action on higher time frame.
Right, it's maintaining, right, exactly. So it's also maintaining efficient price action on higher time frame. So there's not much. Again, remember this is a 1 minute, so be a little bit more lenient with yourself. Okay. So I hope this helped you guys. I think that's where I'm going to leave it off for today. This was a class full of examples. I hope you guys enjoyed this. Does anybody have any final questions before we sign off?
So these are real-time trading.
Sorry?
LTF net trading. You have to watch the structure carefully first.
Yeah, so remember that you do have to watch structure very carefully on higher time frames. Something that helped me out with especially this is use your 5 minute or your 15 minute as kind of your higher time frame structure. That helps a lot, you know. All right, so okay, so question from Sandeep. These will play out only in the kill zone or anytime will work. Anytime will work, but preferably do it in the kill zone, and kill zones work best. Yeah. All right, guys. So I think that's where I'm going to leave it off. Thank you to everybody from North America that's signing in. I know that a lot of people are with what's his name, with Mark Shepard. Oh, sorry, not Mark Shepard. We hedge funds, right? Yeah, with Mark's team. Yeah, Mark Shannon, sorry. Mark Shepard's an actor. Yeah, so Mark Shannon, right. So I appreciate everybody from Mark Shannon's team. I appreciate everybody. I want to make a class specifically for you guys, you know, with what's it called? With North American times. But I want to see more North American people join up, you know. That's something that we'll do. So with that being said, thank you guys for hopping on. I hope to see you guys next time, and take care.